Jan Hatzius is here, Goldman Sachs chief economist, head of global investment research, to break it all down. Happy Friday, Jan. Great note yesterday.
Thank you.
To our discussion, can we let the economy run hot safely?
I think 2.5% is certainly, very solid growth. We think it's actually pretty close to the current potential growth rate, because at the moment that is still being elevated. We don't have the unemployment rate come back down to levels that would be more inflationary. We actually think we'll stay in the low fours for unemployment. The labor market has adjusted; it's now in balance. So even with this, very sturdy growth environment, I think we'll see continued gradual deceleration in wage growth, disinflation, and I think we will also see more rate cuts. We do expect a cut at the December meeting. I think it's true that the recent data have been a little hotter, as Chair Powell indicated yesterday, so there's probably more risk to that. The market is obviously reflecting that, but I also think that the funds rate at 4.5% to 4.75% is still quite high, and I think they will want to bring that down.
So you go to quarterly beginning March, right, next year?
That's right, yeah.
And on tariffs, we showed a chart earlier. I don't know if we have it built for this segment, but you looked at the prospect of tariffs, and 10% across the board, you think that's when you'd start to see some meaningful knock-on effects on GDP, right?
That's what would worry me. I think if we had a broad tariff across the board, 10%, sometimes the president-elect has talked about, even higher numbers, I think that would be more negative for growth, and it would push up inflation by more. Our base case is that we'll get China tariffs probably quite soon after January 20th. And, that's going to have some impact, but it's modest, and there are positives to offset it. Fiscal policy is going to be a little bit more expansionary, and regulatory changes, also growth supportive. So we basically stick with the view that we had going into this election, which is that the economy is going to continue to perform strongly, outperform other advanced economies, and outperform the consensus for the third year in a row.
Just to reiterate, why are you not concerned about inflation sticking around? If we haven't seen, we've seen a ton of progress, but we've sort of been bumping along these levels for the last few months, especially in core inflation, with an outlook that portends more inflation.
Well, there are some important base effects. It's not surprising that the year-on-year rate is sort of moving sideways. This is what everybody expected a few months ago, because we're basically comparing with some unusually low numbers around this time of 2023. I think we're still making progress. The sequential inflation pace has been encouraging. Again, the labor market rebalancing has continued. The quit rate, job openings, a lot of those indicators do say that we're leaving the inflationary period further and further in the rearview mirror.
So you think there's still reason for the Fed to guard against further weakness in the labor market? Because it's harder and harder to make that case, isn't it?
Well, I just think that, again, the funds rate is at a high level. And, as long as we're still in the mid to high fours, the case for bringing the funds rate down gradually is still pretty strong. Once we're in the threes, I think it is going to be a lot more data dependent.